Duriel. Thank you. Thank you.
Here, Mike.
Thank you.
Thank you so much, Danielle. So I'd like to start by thanking our esteemed panelists for accepting to be part of this panel. So I want to start asking a quick question to the audience. How many of you guys work with investors? Okay, so like 40%. How many people would like to work more with investors? Okay, so in the right spot. So for the next 45 minutes or so, we're going to cover everything they need to know about real estate investing. So first of all, I want to ask the panelists to please introduce yourself and share your journey when it comes to like real estate investment and working with investors.
Duriel Taylor, born and raised in Miami. Been in real estate now, 18 years, 8 months, 3 days, and $2 million. My aunt ran a relatively successful asset management and investment firm in South Florida, so in high school, college, I had to do that.
Well, cross my legs. I'm Khalid Bryan, big business. I started real estate in 2013, and just trying to like build and hold momentum. There was an investor that came into the office, and he just needed offers written, so I was just writing a lot of offers a day. Then another investor would see me doing that, and he was like, write offers for me. So I'm like, all right. So it started with just writing a bunch of offers. Then it came to doing evictions. And at a certain point, I realized there's a lot of investors, and they have a lot of problems. So I'll just try to like identify those and build a business out of finding and solving their problems.
Antonio Correa, team leader with One Sotheby's, team leader of the Anchor Group. I start working with investors when I start because I'm focusing international investment. And my clients come from other countries, want to buy the property here. So I manage the property for them. And I like the process. I like the process to renovate the properties for them, to help doing flips and all these type of things and manage the whole process. Since when they start here doing video tours, at the end when they start getting their income every month.
Thank you, guys. So now we're going to get started with the first question to Duriel. So we all know, as you said, practitioners and property users, is that pre-qualifying is a must, whether we work with buyers or sellers. And it also applies to working with investors. So tell us about the process on how you pre-qualify investors and how you help them, or how you try to understand their goals.
Yeah, so I use an acronym called REE, so R-E-E, essentially realistic, their experience and their expectations in terms of the investors. So once I have an idea of what their investment scope is, I try to find the right asset. I don't try to reinvent what they're looking for. I try to understand exactly the cash flow base or the appreciation base, or the vacation, what exit strategies do they have experience in, what exit strategies I can create for them. So I try to understand the investor themselves, and I communicate myself to find the right asset.
If you want, I'm just going to check with the audience in the back. Can you guys hear? Can you hear us? Can you hear the speakers? All good? Perfect. Now, do you guys want to add something?
Yeah, I'm a bit unorthodox just because of the way I got into working with investors. My start is like a big therapy session. So you come into my office, tell me all your problems, tell me about why you are ready to leave your job, and like I get a better understanding of why you're trying to invest and what you're trying to get away from, so I can better like place you in a property, because I wouldn't put you in something that's too hands-on if you don't have time. And Duriel taught me to find out what they want the money to do. Thank you. So I ask that as well now.
I think the first call is the most important call, and when the investor come here and ask about what type of property they can buy, I always ask what they own and what is the goal at the end for them. If they want to live here, want to enjoy the property and rent it out, or they want only get an income property. So in base of the first call, I get in deep with the different type of investment that we can do.
Thank you. Now, the next question is for all of you, and let's start with Khalid. What type of investment properties do you focus on now? And of course, a little bit more on why, because this can go clients to agents who trying to work with their first investor.
Yeah.
So what type of properties and why?
I focus on multifamily mainly because that's where all of my kind of knowledge base is from as far as just residential renting out a property. I like it because just in multifamily, there's so many sectors and categories and just options, and you're helping people at the same time, so multifamily. Oh, and there's longevity. You can figure out warehouses and all of that, but multifamily is always, you're gonna need it.
In my case, it's off-market properties. I try to get what they want, and everybody can see online what is available. They can see online what is available. So I try to call in looking what they want, and that is the best that I do for them, and they love it. They always are good with that.
So my structurality, multifamily, so anything over 10 units, warehouses, medical facilities, and my mother is a doctor, so she sits on the board of OSHA. So I have a little insight of certain parameters of that. Data centers is the new shiny toy. Data centers is going to be the must-have for any Fortune 200 company or more. And I say that because every company now wants a tech arm. So they're going to want AI, they're going to want to house computers, they need house computers to hold all the data. So if you are in that space in terms of data centers, I would say start educating yourself now because it is coming. That new rush is coming.
Okay. So as we know, this is like one of the basics that we should understand when we start working on investments and with investors and investment properties is that the highest the risk, the highest the profit. So now my next question is, what strategies do you use to help the investors limit their risk and maximize their return investments?
So some people like cap rates, some people like cash return, some people like ROI. I prefer square footage. I think square footage gives you more of an idea of what something is really worth in value. I try to understand what the client end goal is, what their beginning goal is, what their 5, 10, 20-year goal is, and then from there, I try to analyze the deal. So for the most part, I only look at the numbers the first day that I'm on asset, but I think match the criteria. I then look at what I phrase as competitive edge and structural advances. So what I do, I look at the location of the property. Is it near Starbucks? Is it near McDonald's? Is it near the highway? Is it near college? So those in particular is the competitive edge. And then the next edge I look at is the structural, right? How many square feet? How many different mixture of the units? Is it all one unit? Is it 2-bedroom, 4-bedroom, 1,500 square feet? Is there any room to add a pool? Can you wash and dry on this premise? So those things are the first thing I look at to help my client understand.
What type of property is that?
That's multiple.
All right, here comes some more unorthodoxness. So for me, the first thing I look at is zoning, because I like when I look at one property but it's zoned for something bigger than that, it's a whole new ballgame. So after that, I don't like when the numbers are tight. If it's already at market rents, it's kind of less of an opportunity. So I like to find a clean property that's just, you can clean it up. It doesn't really need to be rehabbed, but you can renovate it to take it up a notch. And that's that add value. Also, I used to be afraid of one water meter, but I've learned about RUDs. I think it's RUDs. It's a thing you could put on your 1 meter property and it'll measure it out and split it. So it's just learning about where we're at now and finding the add value. And also with that zoning change, especially in like that Fort Lauderdale area, 33311, it can be a duplex, but if something goes terribly wrong, it can burn down. That's fine. Build townhouses in its place, because in some places the zoning will let you do that, and it's worth it.
In my case, to maximize the return, I think they need to buy under market value. Under market value, and that is the only way to get a best return and get a best properties.
Mm-hmm.
And it's interesting to see you guys have different approaches and different perspectives dealing with the same type of investment.
Yeah, because I work in residential. Residential, if you buy under market value with appreciation in the next following years, you can get a nice investment.
Okay. So the next question is about formulas, insights that you use when we sit down and advise your investors. So what kind of formulas you use, metrics, and insights?
Yes, I have a few formulas here. Cash on cash return, that is the most important, I think.
So can you break it down, tell us more about that?
So you have the annual net cash flow, and you divide by the total cash invest, and you guess what is the percentage of return. So if it's 20,000 in annual cash flow, you invest 100,000, the return is 20%. So it's 20% on cash return.
So some kind of investments could be like the down payment and closing costs you put up front, and that's your cash return on that property, right?
And what you get from the property, the income, and what you get an annual cash return, you divide by how much you put for that property. I have a
Yeah, do you think? Go ahead, we got time.
cap rate. So when you have a net operating income, so NOI, divided by the property price, you get the cap rate. Cap rate around 5% to 8% is a good cap rate. Under 5 is okay, but it's not the best for our investors. Another is the DCR. So you divide the net operating income by the payments, so your loan payments, and you get a percentage that needs to be between 1.3 to 1.6 to be a good percentage. So how much you earn with your property? If you earn like 20,000 per year and your mortgage is 15,000 per year, you divide that and you get 1.3, 1.5% is a good return. So
that can be tied down because of the costs.
yeah, these are a few of the formulas that we tell our clients to use.
All right, so for me, from 2013, when I started real estate and that state exam, when they taught me the T formula to get a cap rate, I've been all in on cap rates. But since, got around YPN, more advanced real estate skills are being used, so I've since taken the classes and now I'm learning how to explain cash on cash returns and internal rates of returns. And I'm finding that the cash on cash return is really what you care about because that's telling you how the money you put in is doing. But the reason I use cap rates more because it's quicker, it's simpler. I can kind of estimate the numbers until I get them locked in and just tell you, here's the cap rate. Also, it helps me faster with figuring out what I'm offering. I'll look at comparable buildings or properties in the area and see what cap rate they were purchased at based on condition. And now I know, well, if everybody over here is getting 8% cap rates, we're not taking anything less than 7. So now we know what offers to not accept because that's how you measure your risk. If it's a risky deal, we might need to crank it up into the double digits. Not saying we're going to get it, but just saying I'm teaching people to fall back a little. Don't just be so hungry to purchase a property. If you can't get at the cap rate you're looking for, ignore it. Oh, and fun fact, don't factor the mortgage payment, the debt service into your cap rate calculation. And I got time for one more little tip here. And then what I do is, even when I'm sending my rental offers or any offers, because I'm just a cap rate guy, I'll include it in that offer. So I'll say, look, I'm giving you X amount per month. I know it's but it only changes your cap rate by this much. Look how much this improves your cap rate, especially if you got a questionable applicant. You need a big cap rate. Here you go. So they're reading this guy knows the stuff. I like it. Let's take it,
Yeah, I go a little opposite. I go per square footage value. Secondarily, I look for any ad opportunities for my clients. I love clients that say, you know what, Duriel, I'd much rather keep my money in stocks. So I say, okay, well, how much money? So they'll say, okay, well, I'll probably do 60,000, right? I say, okay, let's compare that to, for example, a smaller multifamily. Let's look at a $600,000 purchase, right? So you're gonna put down, let's say, another 10 for that, right? So you're at 60 on both sides. And then on average, let's say on just assumptions, APR, you're going to do, let's say, 7% returns in the stock. So now that stock is probably worth, let's say, 67, 68. Right?
And this, by the way, no objection. This is something you guys are going to get a lot. You just compare investing in real estate versus different asset class and probably like investing in stocks. We get this a lot, right?
Yeah.
So I want you guys to pay attention to the answer.
Yeah, so I'll say, okay, well, now you're gonna get 7% return on your stock, right? You own that stock, great. So now you're subject to the market. Okay, great. Now, the multifamily that you just purchased at 600,000, you put the same 70,000 in, all in, closing costs, little upgrades, whatever the case may be. Let's say next year that property now balloons to 10% appreciation, right? You did all the X, Y, Z. So now that property is worth almost $700,000. So what is the major difference in terms of you go from stocks to multifamily? So I try to give them real life situations from appreciation, whether it's natural or forced appreciation. And forced appreciation, you know, you put in drywall, you put wash and dryer, you put a pool, whatever amenities, those are forced appreciation. But naturally, just as the dirt sits there, it's gaining appreciation. So I compare those two, give them on a document so they can read it and have a reference. But that's how I make sure they understand that real estate is a better goal than stocks.
And to a certain extent, this can be like investing in real estate can be a low risk, obviously. It can be like less profit, less return, but less risk.
Yeah, because you have individuals who can tweet something and put something on Instagram and lose value of stock ownership they have. With real estate, it's literally you are the lord of that land. So you can, whatever, even if it's a warehouse, even if it's a multifamily, it's a data center, you control that. So you can, again, we're still subject to market pressure, but to some degree, you can make sure that property, that asset, is still appreciated by something that you visited and put into it.
Okay. So the next question is, what risk do you guys consider when you're into this?
For me, is low cash flow. So that is a big risk. If you don't have cash flow today with a property, don't buy it because it's not going to get better with time and no. If this investment is only about numbers, about returns, and the cash flow is first for me.
For me, he's right. I like the concept of if the numbers are too tight, it's okay to let it go because maybe that's meant for someone that's trying to live in it. So you just have to like make your rules and stick to them. So when I'm taking on a client, we're going over, these are the rules of, here's how we do things. We're not going to go that far. Outside of that, just making sure you're not just purchasing a property because it's rented out and actually screen the tenants. Not to say screen the tenants, but I would ask for the last at least 6 months of rent payment history to see, are these people in place paying on time or are you just afraid to evict them? You'd be surprised how many owners are just afraid to evict. And I need to see the last executed lease because it might be from 1967 and you just never wanted to renew the lease because you like it. So all these things matter to when you're going to take over because they might love this person because they've been there for decades and then here you come to quintuple their rent because they've always been under market. I feel like I have more, but we'll revisit this.
Yeah, I mean, again, I think it's important to understand what your client's investment strategy because a deal that may not make sense to you may make sense to them. Some clients have taxation reasons, some clients like cash flow, some clients want to demolish and rebuild. So I think it's important to understand what your client's investment goals are to determine quote unquote what's a good deal to them. And then once you find what's a good deal to them, then you give them what they consider a good deal.
I got one more, if I got time. And then the one more thing I forgot to add is no matter what, always check zoning. Check the zoning because you can be buying a fourplex and in the zone for a single family. You'll be surprised. So never not check zoning.
So the next question is what realtors get asked the most probably, and this is probably a question that most audience has in mind now. What markets or neighborhoods in South Florida do you see as emerging opportunities for investors?
I can start. In my case, for residential, I do like property manager and manage property for rent, rental incomes, etc., etc. So for me, West Broward is a good rental market. Weston, Pebble Pines, Plantation, all that area. Another good market is downtown for luxury appreciation coming up in the following years. And Brickell luxury rentals, for luxury rentals and multifamilies. There is other few markets too.
And it's actually markets where we see benefits of ours now. We see sales giving concessions, and it's really a great time for investors and buyers.
Now is the best time to buy. It's the best time.
So like I remember something that Warren Buffett said, which is buy when it is fear, right? And this is something that I want you guys to share with your buyers. Everyone is going to buy now, but this is like a master if investing I shared years ago. Buy when there is fear. And this is exactly what we're going through now. So let's go to
So the markets and property types and things I'm talking about the most, I can't stop talking and vlogging and doing research on Lehigh Acres because I believe they're leading the state in development. Like there's so much land down. When I first found it, you could buy like 10,000 square feet for $10,000. Now, then it was like 15. Now you go down, it's in the 20s. So you're watching that growth, and there's developers out there that can afford to acquire an entire block and develop it. Outside of that, I really like the Fort Lauderdale area, just like where you see that redevelopment where they're buying single family homes and then tearing them down and building 2 townhouses in its place. I'm infatuated with that. Homestead is crazy. Florida City? Yeah, just down there, that South Miami area, there's so much land there. And when they start coming in, when these data centers that Duriel was talking about, like data centers is gonna be a real thing. And then so now you gotta like look into like power supplies and alternative energies. Look out for nuclear power. Like all this stuff matters. So I like that area, and West Palm Beach, because big business coming in is making office space quite expensive there. So West Palm Beach, which also had lower house prices.
Again, I always lean to what the investors like. So if you're asking me what an investor from a low risk entry point, tragically speaking, right, Surfside is a great entry point right now. There's a lot of fear of the foundation there. There's a lot of fear from a structural standpoint. North Bay Village is also a great area. They're actually leading the state in terms of units coming to market in the next 5 years. I agree, Florida City, where it said that. I think Florida City is definitely going to lead the way because they have a lot of land down there. They're pretty much excluded from a lot of the major cities down here. Also, I like West Palm Beach. West Palm Beach is going to lead the new Wynwood North. Related Group is one of the biggest developers in the country. They're doing a little bit different in terms of how they develop now. So they're following the education model, right? So they want to build infrastructure for a higher level of private education. So when executives come down, a lot of executives' biggest gripe about Florida is that there's not a lot of private school education from a higher level standpoint. So if they give the infrastructure of having Harvard, MIT, principals, whatever the case may be, to run these institutions, then they'll start building around that for forming ground up. So West Palm is definitely going to lead the way. I would say 6 years now, West Palm is going to lead the way.
I got one more if I got time. And if Tara is still here, the ultra luxury market, just Jeff Bezos, Messi, like all these big businesses coming in, and in Palm Beach data centers, like you just gotta imagine with expenses to build properties going up, it has to make sense. And you gotta sit with it. Everyone here needs to like book a consultation with Duriel, because he'll tell you later his concept on like what would you call it, like K through the school system relevance to the ultra luxury market that he conceptualized. Duriel wakes up at 4 a.m. and looks at just news, so things to know.
Questions that I've asked you so far about why, and this question is about how, where to get the money, right? And this question can be good for like our research practitioners, whether they want to advise their investors or just do it themselves, where to get the money to invest, right? So my next question is, what's some creative ways to finance investment properties, especially for those who just getting started?
The most common one is seller finance. I think everybody's pretty much heard that, seller finance. I think now the market allows you, from a buyer standpoint, to take the terms. I had a crazy deal the other day. A client, I was in the seller, the buyer came, and he wanted to offer 2% interest rate at 5 years. And we laughed, and we joked. But then my client out of nowhere said, okay, I'll take 5.6. So, you know what? So I think if you can create value for the terms, and that particular offer, they did not have no prepaid penalty, which if I were writing a LOI for a buyer, then I would definitely have no prepaid penalty because it protects the buyer seller. But I think seller finance is a great one. Transferables are great as well. Assumable, I think that's great as well. So if there's a loan on it, you can assume the loan. And then one of the biggest ones outside of seller finance, I think, is purchasing the LLC. So if a company owns the real estate, then don't buy the real estate, buy the LLC. I'm not an accountant, consultant, accounting first, but it protects you from a taxation standpoint, limit the taxes, so it's all like it.
No question.
So what do you question
This is my favorite question. So, in my case, I work with international clients, and I tell them, look, right now the dollar is suffering. Why you don't get money from Europe? They have investments in Europe. They can bring money here, and they earn money only exchange the dollar to euro. And there is other exchanges that you can do it, but I'm telling my clients to finance there, to bring the money by cash here, because you get a great advantage right now. Another good financing is the DSCR loans. Now we have a contract with 90% loan to value in DSCR loan, so they don't look at your income, they don't look at nothing, only at the property and how much the property is going to rent. If the property rent less than the loan amount, you get the loan with 90% loan to value. So that is two of the ways that I'm working right now.
So the most interesting financing things I've come across lately is I got close to closing a deal where the seller financing was the seller wanted to finance a certain percentage. And we had the lender come in with the other percentage. So the buyer just had to plug in a very small amount. So that was interesting. Also, we have a fourplex with violations on it that other lenders wouldn't touch, and we're working out a DSCR loan on it. So it's just important to know multiple lenders and just see who's doing what. It's actually what the guys are here the other day, matter of fact.
Actually, so while we're preparing for this panel, also discuss this, kind of like great way to finance your, help your investors finance their investments.
Yeah, I mean, in the construct for SBA, they allow you to put a minimum of 10% down, and it allows you to acquire an asset in the business. So if there's a warehouse and it's 50,000 square foot warehouse, it's, whatever the business is, Nike, whatever, you can buy a Nike, you can buy an asset, let's say $10 million, $1 million, but I'm not really sure what this administration is going to do.
Thank you. So the next question was something you guys mentioned earlier on, which is off-market properties. So now this is a good source of business, right? How do you source off-market properties? But also, we know that these properties can be a little bit tricky. So how do you protect your client and yourself in these transactions?
So my personal strategy is to just super simplify everything possible and then find a system for it. Like I do a bad job until you can do a good job. So in simplifying it, when I'm cold calling for sale by owners and expireds, they want to sell. They don't want to list with me right now. So it's like, all right, so you're an off-market property, And then when I'm calling my database, all the investors I've worked with, the people that want to invest and all of that, they're like, look, I want to buy, but at a certain point, you have to earn the respect of these big investors. They're not signing your brokerage agreement, So what do you do in that situation? I got an off-market buyer and an off-market seller. That's how do we merge them? So sometimes I'll do like a NDA, a non-disclosure agreement with the investors. Like, look, just sign this before I give you the address. You can go check it out. Or when I'm cold calling the seller and they're like, look, I don't want to list. Well, would you sign a showing agreement? Would you, more often than not, they'll pay you if you sell it. They just don't want to commit. So I just simplified in that way. I have a database, the database of off-market sellers, and it's on Google Earth. Google Earth is crazy.
So before you show the property, you make sure you sign a showing agreement.
Yeah, but in this situation, I'm not showing anything. Then at this level of investment, they just want to drive by it.
I want to emphasize a little bit more on this, because a lot of our Asian people just excited the first investor, and they're just like, go ahead and you're showing. But obviously, you want to skip these steps, right? And this
Yeah.
is something that, as mentioned earlier, nobody's about the process. So signing a sharing agreement or a business agreement is on us, right?
I have an example. I just closed a property that the buyer don't find the property online, and I start calling the building, and I found a owner of two properties there. They have the two properties rented, and he told me, look, I have two properties. If you want, show one of them, and if your client offer what I want, it's yours. So was the highest sale in the building. I procured the off-market deal for my buyer, and the seller was happy because it was his price. So I signed the buyer agreement to the buyer, leasing agreement for the seller. I got both commissions and with one call. So there is many ways to do that.
So we have 4 minutes to go. I know that we're going to take one or two questions at the end. What is a one piece of advice you wish every first-time investor would follow? So would you agree?
Understanding what they want. Don't think I'm going to create this fairy dust of your investment strategy.
And let's take us back to the first question, which is sitting down with investors, pre-qualify them, understand the goals. Agree?
Can I give two? All right, so my number one rule is if you make sure you can afford to handle an income property before you get into investing, because if the AC breaks, you have to fix that. There's a landlord-tenant act out there. You can't just leave properties and just assume the tenant's going to handle it. The second thing I would say, when you do a Section 8 deal, they give you this paper that says, here's how much we'll pay per zip code and per bedroom and all that. Don't use that as rental comps when making a decision purchasing this property, because that's not necessarily the amount they're going to pay you, and your numbers will be all messed up.
For me, it's buy for cash flow, no for future hope or future, I don't know. Cash flow today is what matters.
So the last question is actually about having or making our real estate practitioners thinking about investing in themselves. There's something that I heard years ago that Gary Keller said, which is when you come across, when you sit down with an investment appointment with someone like myself, the first question you ask yourself is this sale or this deal good for me? So you think about buying first. So before you even come on the market. Because and I'll put so many panels about this, and also if you go online to our ask, what was the name of the
Help Me YPN?
Yeah, Help Me YPN. So thank you for that. We put together a whole session about how we can practice what we preach, right? So my question to you guys is, what is the advice that you give real estate agents who think about investing? What's the due diligence you should work on, and what you should think of first?
Same thing, sounds like a broken record, but what do you want? So when you start in your early 20s, 30s, whatever the case may be, understand what you want out of that investment, right? So everybody has a different strategy when they start in real estate and then they get later in their career. You may be cash flow based to where you say, for example, as a realtor, I don't care what HGTV tells you, we're going to make commission every day, every hour, right? So if you have some source of supplemental income, especially with multifamily or your warehouses and sublease, for example, it allows you to say, okay, I don't have to necessarily reach for this property, but if it makes sense for me, to your point about cash flow, if it makes sense for me, then that's something that I can definitely explore.
For me, I would start by saying go to class and stay in class. And just because you're a realtor, you hold a license, that doesn't kind of grant you to take your first large commission and just sink it into a property. Make sure you can take care of it. Make sure you understand the concepts and how to screen and how to do everything appropriately. And just the same, having that first investment property doesn't just authorize you to say, let's go invest together. Outside of that, I would say just don't forget your lead gen. Don't forget you're a realtor, because you're going to need to support that property you're planning on buying. So you need to be able to balance both unless you plan on making a full transition.
And probably I think one extra minute just to answer the question that I in the back. Do you have a question?
Yeah, and I think you guys kind of talked about it after the fact. When you said buy the business, you needed family homes, or you meant more like commercial? Because then I was gonna go with the SBA loan. If you go commercial, I don't think you can do an SBA loan on a single family home, even though you're buying the business and the business is providing income. I'm not sure if that's the term what you were looking at. I guess the trade process when you said it was the SBA loan, which you mentioned it after that.
Well, actually, with the single-family home, if it's a business, right, so ALS, for example, daycare as well, you can actually use that SBA for that residential, right? So it can be a single-family, and then obviously that also goes for the commercial.
Yeah, so it depends on what business they're running out of that single-family home, as like you just said, ALF or a childcare.
If the deed is an LLC, so whether it's daycare or they do, if it's zoned out, but if it's zoned for business.
Special purpose.
Correct. Yeah.
All right, thank you so much. Let's give our panelists a round of applause. Thank you, Duriel Taylor, Antonio Correa. All right, so we're
Yes, sir.
taking a 10-minute break.
Yes, sir.
Not
Wonderful job. Wonderful job.
Go ahead and take
Wonderful
this
job.
out.
Wonderful job. Wonderful job.
Like you're ready
for
You already know me.
And we'll do one more drawing and a quiz, so you still have 2 chances to win cash money today.
Okay.
So a couple of questions now. We'll be back in about 10 minutes. Thank you so much for coming.
Oh, just bring that's me. Just bring it back to the board. But yeah, don't talk to our sponsors, please.
Yes, sir.
And if anybody needs a passport, so you know.
I'm about to get a plate. Ooh.
Let's do this next.
And that was test run 1.